Welcome, CFA charter holders, CFA Society of Chicago members, and our guests. We are back with another episode of Macro Matters. We are on our sporadic summer schedule, so we're not quite every other week, but we're trying to stick to it as much as we can. Once again, my name is Rich Excell, and I'd like to welcome my co-host, my colleague, Tony Zhang. Tony, welcome. Good to see you.
Hi, Rich. Yes, there's been quite some time that we haven't really talked about the market, the economy within the macro matter. And apparently, over the past few weeks, there have been a lot of things happen, either weird or unweird, like ranging from the market chaos or IT chaos to also like maybe former President Trump's like attempted assassination. This is
Yeah.
so many things have happened. I think this is already creates a lot of confusions over the market. I think this is right now is the perfect timing for us to discuss about this, even before maybe the earning announcements of the uh what the Max M7 starting from today.
You're absolutely right. I mean, here we are on July 23rd, and we're in this week and next week are the two busiest weeks of earnings. You think that's what we should care about, but as you're kind of talking about, the last couple of weeks have had some of the craziest news that I've ever had in my career. And I've been around for a long time, Tony. I've seen a
Me
lot,
neither.
and I can't say that I've ever seen anything that looks like this.
Correct.
But
Yeah,
what I thought
unbelievable.
we would do, maybe because we talked about some things, because there's a lot that we could catch up on. But maybe I thought that for those on YouTube, you'll see that I'm sure going to share my Bloomberg, but we'll talk through it for those who are on the podcast and just try to get through some of the ideas of things that have been happening here in the markets. So I'm gonna start with um, I want to start with the first thing I want to start with, Tony, is top of mind because here we are, July 23rd, and crypto ETH ETF started trading today. And
Correct.
so crypto has definitely been in the news and it's been all over the place, right?
Correct.
If you go back a couple weeks ago, because there was, we had the Mount Gox. Everyone thought that everyone's getting their money back from Mount Gox and they're selling it in the market, increased supply. We saw crypto at 30-day lows, and here we are 2 weeks later, and we've got two things going on. We have Trump is presumably in favor of Bitcoin, and now Ether is launching ETFs. Crypto's all over the place. Lots of different news. What are your thoughts on crypto as we sit here on Bitcoin, on ETH, on all of the different coins right now? How are you trying to think about it, Tony?
Yes. So what had happened over the crypto market has been contrary to what many retail investors, institutional investors believe. In the past, what they actually believe that with the introduction of the crypto ETF, spot ETF, including the Bitcoin spot ETF and Ether spot ETF, we should see or we should expect to see the decreasing volatility of the uh, cryptocurrency, including both like Bitcoin and Ether. And apparently, that's not the case over the past few weeks, right? And we continue to see Bitcoin and Ether, just Ethereum, right? Went up and down 8% or 10% within a day, or even sometimes overnight. And we actually do respect that cryptocurrency trading over 24 hours nonstop trading. However, this type of volatility always put a question mark over the institutional adoption. Now, even with the introduction of the ETF, spot ETF here, this is something that we feel, at least from my point of view, that I feel kind of a strange. And apparently, over the past 2 weeks, we uh, saw so many things, geopolitical and political issues like happening, which might have significant impact over the market, including the crypto market. How so many things are coupling together, but one thing is certainly for sure, just in the past, is people thought that uh, cryptocurrency, especially the Bitcoin and Ethers, one type of assets or one type of risk averse assets against some political events. Now, this is certainly not happening, right? Because we saw the like attempted assassination for former President Trump, but we actually don't see right now the Ether's price appreciate significantly, even with the pending news about the Ether ETF. So apparently, even today, it's the first day that spot ETF is being traded. Now we
Yeah.
see that actually the price. Most of the price are actually going down instead of going up. So contrary to many people's belief. So here is what one type of maybe explanation will be some liquidity constraint and some risk averse um, behavioral sentiments going on here. This is how I interpret that. I think this is not, at least not certainly a good sign for tech, because like usually we see the high correlation movement between cryptocurrency and also the tech, like Nasdaq stock. But this is certainly not a good indication for, I think, the tech name, especially start today. We started kick off with Tesla's earning right after the market close.
Yeah, I would agree with you on that. I've and it's not just in the last year or so. I've always felt that Bitcoin price action is either coincident, if not leading a little bit, the overall risk appetite in markets, which we see with Nasdaq, with the Mag 7, et cetera. And that has definitely gotten a little bit disconnected. I mean, we saw some of the Mag 7 stocks rolling over a little bit ahead of
Yeah.
earnings, but they've bounced. But I think you're absolutely right. And I've seen some studies that suggest that the average retail account, here we are about 6 months into the Bitcoin ETFs and institutional flows of Bitcoin, and the average price people are long from is about 60,000. We had traded below there a couple weeks ago, and now we got back above there. But I think you're right that there's a little bit of congestion here as we
Mhm.
try to we try to sort through and consolidate the flows we've seen in Bitcoin. And I think the reaction, while it was a pretty good start to the day on the Ethereum, ETFs, um, you know, I think there's an element of buy the rumor, sell the news at this point, on
Correct.
some of these ETFs, and we had seen that on other sort of catalysts in Bitcoin and Ether before, that there was a diminishing impact on these news items as more and more people are looking at it, and I kind of think that that's what we're seeing here today as we see some consolidation. But one of the things that we saw talked about with Bitcoin in particular of late. You mentioned the assassination attempt, or is it a political hedge, et cetera?
Yes.
Is it a hedge against big government? It's presumably a hedge against everything and maybe nothing, but there's a lot that have been kind of putting it into that same basket of part of the Trump trade, because Trump will be speaking at the Bitcoin conference in Nashville, and is presumably indicated that he might want to consider Bitcoin as a reserve asset.
Yes.
Um, he, I, what do you think? Not necessarily about Bitcoin as a um, being levered to Trump's candidacy or not, because I think when you look at the polling numbers versus Bitcoin price, there isn't really a strong correlation right now. But what do you think about this idea of a broader Trump trade, and what parts or what things go into that Trump trade that you've kind of heard people talking about, Tony?
Yeah, Richard. Over the past few days, apparently Trump trade is a very popular terms flowing over the market. And what the Trump trade, definitely different person or different investors might have a different interpretation. But a general perspective or general expectation will be former President Trump would actually favor the traditional energy company. So instead of actually continue to advocate about the clean energy like solar, um, wind, or even nuclear energy, apparently he favored traditional like oil, crude oil energy to actually to power out the energy consumption in the U.S. Now, um, apparently this is happened in his last episode within to be the U.S. government between 2016 and 2020. Apparently, during that time, we do actually see the oil price continues to go down. And compared to what we saw from since year 2020, now the gasoline price has appreciated significantly over the past few years, which actually simultaneously leading to high inflation in the US, which I mean, in his words, like simply crushing is like every people's like a daily life for like average American citizen. So this actually from average American citizen point of view, this is certainly will be the case, and especially he handpicked the JD Vance as his running mate, which actually who we know is like also came out grew up from Ohio, where typically suffer from what he did, what he saved as like a globalization. So apparently now what we can anticipate it if President Trump got reelected. So this kind of a deglobalization and simultaneously like a pro the traditional energy will be one type of trend. So we should actually expect the energy, the energy might certainly either stable, even sometime might actually slightly go down, because what's going to happen is we're going to see the U.S. to become more of a oil exporting country rather than importing, because we do have a lot of shale oil reserve here in the US. So that's one part of the Trump trade. The second part of the Trump trade is about the deregulation, which actually tend to favor the small cap company. Apparently, this is had coincided with the market. Market did actually believe what did happen in the week before last, and also last week. We saw the small cap stock outperform or diverge from the large cap counterpart over almost like 11.6%, I think, over the 5 days trading window, which tend to be an outlier running more than like a 3 standard deviation from the average from the 5 day trading window since like a year maybe 1995. So this is actually a lot of the market reaction actually has consolidated one belief, like they are trading from the presidential election uncertainty to presidential election certainty, which means like the market actually believe that President Trump will be reelected, or at least have a favor or have a high chance to be reelected. But this different people might have a different view, and simultaneously the Trump trade coincide together with like the softened labor data, which actually push the market to believe that Federal Reserve is going to cut the interest rate in September. Certainly. Now, all of these things just make the almost a 3 standard deviation movement within the small cap company over the large cap counterpart happened last 2 weeks. I think this is something historically, as what you mentioned right at the beginning, just this year we continue to see historical events happening everywhere, every corner. So we still, I think we just still half of the year and running from now on, and we probably should see more. But apparently, as what President Trump mentioned, that like now he actually favored the deregulation, so which tend to sometimes tend to favor the small cap company and favor the energy, favors material. And if he is right, and if he were re-elected, then probably we should continue to see more of infrastructure spending, so which actually might benefit the
Yeah.
industrial industry. So that's, I think, most likely would happen. Yeah.
You touched on a lot of stuff there that I definitely want to get to, and because a lot of good stuff. And so I'm right now, I had up the crypto screen, but now I moved to the commodity screen, and after that we're going to look at some factors. But I think you're absolutely right that the one thing that might be pretty clear difference between the two candidates that we have right now, or the two parties, I should say, we don't know who
Yes.
the Democratic candidate is. We assume it's Kamala Harris, but we're
Yes.
not 100% sure of that yet until the convention. But I think it's interesting when some people think that, um, Trump favors energy. They think that that might mean oil price goes up. But I think you absolutely hit on the head that it really, what it really means is more supply, and
Yes.
that we're going to see more supply of not just oil, but also natural gas. And
Correct.
that, now, of course, it's a global commodity, and so it's supply and demand. And so the question ultimately comes down, what does the demand outlook look like, and what are other players in the world doing about supply? And so it might be a relative move within, but from an overall standpoint, you would think it incrementally means more supply. We certainly saw more of a push towards environmental and renewables, et cetera, greener energies under the Biden administration. But that said, the Biden administration was willing to bring on that supply of oil to drive prices down before the midterm elections in 2022. And so I think you're absolutely right that consumers understand, or consumers really look at that gasoline price as a
Hmm.
as a pretty big gauge of inflation, or inflation that they're seeing, because it's a number that is, people are all aware of it, right? You might ask them for whatever they think the price of milk or bread or cereal is, and they may not know, but they all know what the price of a gallon of gasoline near them
Hmm.
is. And so that's definitely something. And now that might favor, we might look at that from a sector standpoint of looking at energy stocks. Will energy stocks outperform the broader market or not, because they're able to produce some more supply and maybe take some market share globally? But
Sure.
I think you hit on that. But I wanted to also touch on some of the other things that you mentioned, because I think it's really interesting, is is the factor performance. And if I look at the factor performance on a sector neutral standpoint, um, you actually touched on the size factor, which you can see on a year-to-date basis. That size factor, which was not particularly working, has really made up a lot of ground in a very short period of time, where small cap stocks have massively outperformed, and that was driven initially by a fair bit of short covering, right?
Correct.
That was the first part of the move. But now, as we kind of go into the next part of the move, um, investors are asking, can this continue, right? Is there a
Correct.
deregulation impact from Trump?
Yeah.
Um, and, and what else could be driving this? Of course, if we look at earnings, which we talked about before, are the big part of what's going to be going on here the next 2 weeks. Large cap earnings have been pretty good this year in the last 2 quarters. Small cap
Hmm.
earnings have not. And so it will be important to see if small caps are able to deliver on earnings. But if we just look at, I've brought up over the last 5 years, I've got a couple things on this other chart that I'm showing you. I've
Hmm.
shown you the white line here is the performance of Russell versus the SPX. And we can see that over the last 5 years, the Russell has continuously lagged the S&P 500.
Yes.
Even with that big move we've had in the 10% in the last couple of weeks, if you will, really this month in July,
Yes.
we're still not quite back yet even on a year-to-date basis. And so
Right.
there could be more to go, and there might be a chance for people to play catch up. But a couple of things I've also overlaid onto that, which I think are worth noting, is, first of all, the blue line I have on here is the relative performance of financial stocks versus tech stocks.
Hmm.
Because while these indexes are broad and they cover a lot of sectors, it's pretty clear that S&P 500 has more exposure to tech, the Mag
Correct.
7 names, et cetera. And Russell 2000 has more exposure to financials, especially smaller cap banks, insurance companies, et cetera. And so
Certainly.
there is definitely an element um, of sector rotation that kind of goes into that. And sure enough, we see that when the Russell's been lagging the S&P, it's coincided with the financials lagging technology. And
Exactly.
while Russell has spiked versus the S&P lately, so have financials relative to technology. And perhaps a lot of this has to do with the other thing I have on here in the orange is the 2-year US yield. Now, I've inverted it to kind of show you that when yields go lower, that benefits small cap stocks relative to large cap
Hmm.
stocks, and it benefits financial stocks as well. Um, because not only are the small cap stocks most levered to deregulation because they don't have the capacity to spend the money on all the regulatory compliance, et cetera. But they're also have fewer outlets to go and try to access capital markets. And
Yes.
so lower rates will definitely help small cap stocks relative to large cap stocks. And we've both been kind of on record that saying that we don't see any rate cuts this year. And the market is pricing in another rate cut
Yeah.
in September and then one more beyond that. But the market itself, with as we see via the 2-year yield, is absolutely pricing in that the Fed's going to start on the rate cuts. And that may be another thing that the small cap stocks like, driven by the sectors, but driven by small caps overall. And that's something that when we talk about could this continue, I still am a little bit cautious because we've got earnings these next couple of weeks, and small cap earnings have not been that good. But as we both know, portfolio managers that might be lagging their benchmark because they're not overweight the mag 7, 5, or 3, or whatever you need to be overweight, are
Correct.
probably looking very closely at this Russell and thinking, is there some way that they can play the catch-up trade by getting involved in some smaller names within their universe? What do you think of that?
Well, certainly, Rich, you touch on so many, I think, very important points. I'll actually maybe start to comment from the end, the way you actually pointed out that many portfolio managers like have continued to underweight the Magnificent Seven within the current portfolio. Even like 1 week ago, we continue to get the data. To indicate that portfolio managers are still on the way. So here at just here might actually come to a crossroad that should those in a portfolio manager continue to maybe overweight the rest of the stock in addition except Magnificent Seven, or should they actually try to jump into the trade over the catch-up trade? This is many actually issue, many drivers, a factor behind that. Rich, we both agree that we don't anticipate the Federal Reserve is actually going to cut the interest rate, but actually, market actually priced in September 93%. So certainly they're going to have a one cut, and most likely they're going to have a second cut in December, and will continue to cut this over all way through in 2025. Now, this is actually it's actually becoming a little bit concerning to me because most of the time the Federal Reserve either actually whenever they did cut the interest rate, as what we have seen over the historically over the past 20 years, um, contrary to what many people believe that cutting the interest rate would actually help the equity market, that's actually exactly contrary. Because whenever they actually started cutting interest rate, so 6 months after the rate cut, we would in average you would actually have the market, including S&P or and large cap and Russell, actually tumbling in average more than 8%. So that's especially this year because now what many people continue to believe or continue to think that we are actually in a strong economy at this moment. Economy is becoming so resilient. But over the past 2 months, we start to see some softening over the labor market. Like we start to see actually the unemployment rate start to pick up. And what that's actually telling us, sometimes this is what we kind of concern, because Federal Reserve has a two mandate. Apparently, controlling the inflation is one of two, and the other is actually to maintain or actually to make sure maintain the high employment rate or maintain the low unemployment rate. So either one of them. I'm actually in this year, this is kind of a concerning because of the introduction or continued growth of the generative AI, which tend to enhance the productivity of the people, the labor. In that sense, like we with everything remaining the same, we should expect to see the higher productivity, which transfer or which will translate into higher unemployment rate by nature. Because over the technology advancement technology shift, this happen all the time. And simultaneously, if the Federal Reserve really saw the softening of the labor market, then they might actually cut the interest rate sooner than necessary. Because at this moment, the inflation still remains high. It's like GDP, the still higher than 3%, which is actually still much higher than what they anticipated to be the long run, averaging 2%. So even cutting the interest rate in September, which I still don't believe, even the market price in 93%. And the reason for that is we all agree, or at least both of us might believe that Federal Reserve might not actually might not step into the way for presidential election. This has turned out to be very risky political movement. But now we couple with the softening of the labor market and simultaneously with the introduction of the generative AI, if cutting interest rate higher, we might see a short-term pop of the market, then leading to a crash. So this is something is concerning to me. Now, this is apparently Richie touch on point on about the finance has been actually underperforming the technology over the past 5 years, and recently we do see the financial company, including the Goldman and Wells Fargo, JP Morgan, reporting historically very good like earning. But that kind of earning, apparently one side, we saw investment banking revenue continue to increase, but also coming to play that we had see the SG&A, which actually the cost actually is going down, that can be achieved by two things. One is continuous lay off people, right? Continue to lay off people. The second is you hire maybe like same of a human being or experts with lower costs. So that might be the two things. So this is a couple of things couple together. I'm still not convinced by the move over the past 2 weeks that small cap would actually would continue to go up from here. Even though it might, if Federal Reserve did actually cut the interest rate in coming September, but even though that might be the case, it will be a short-term run, in my opinion. What do you think, Rich?
Yeah, I think you make some really, really good points there, Tony. And I think that the question we have to ask ourselves is if the Fed's cutting rates, why are they cutting rates, right? Are they cutting
Yes.
rates? They're cutting rates, and then why have stocks generally performed poorly when the Fed's cutting rates? And that's typically because they're cutting because there's a recession that's about to
Yes.
start. And right. And
Yeah.
when we look at the labor market, as you mentioned, the labor market is definitely getting softer. You can look at that either anecdotally, just talk to people and they'll tell you how the white collar labor market, whether it's technology or financial services, continues to be soft. But we
Right.
see that in the continuing claims, right? The initial claims have had some seasonality impacts, and so they've been a bit more noisy. But the continuing claims have been clearly marching higher for several months now. And when that trend turns, it tends to persist. And when it persists and marches higher, we see a recession and we see higher unemployment rate. And if we
Mhm.
start to continue to see a higher unemployment rate, we're going to trigger the Somme rule here in the next month or two, which is, again, another sort of indicator that just tells us that towards the end of this year, we're looking at a recession. So will the Fed be able to cut rates and preempt that recession, or are they going to wait until we actually see that? A lot of what you're talking about, it starts to me starts to sound a lot like the 1970s, where the Fed wanted to cut rates, or the 60s and 70s, they wanted to cut rates because they worried about some economic weakness, but inflation was under control. So they cut rates, and next you know, inflation took off, and then they had to reverse course, and then that was the worst of both worlds. And so I'm with you that we see that prices have still not corrected. I think too many people are making the really bad mathematical error of extrapolating a couple months of zero inflation to what that means for an annual inflation rate, which is clearly not zero. It's higher
Yes.
than that. And we have some seasonality effects on inflation that have brought it down, but we're gonna be those seasonality impacts are probably going to be pressuring inflation a little bit higher. And so all of that, what the Fed does, I think we'll learn a little bit more at the Jackson Hole meeting, et cetera. But I think there's still a lot to go on. I think the market is absolutely pricing in the soft landing, and clearly
That,
in a soft landing, if the Fed cuts and we have a soft landing, stocks should do well, and small cap stocks should do well. But I think that I think the jury is still out. I mean, the market's fully priced it in. Are we going to get it? I'm not so sure. We will see. But I wanted to go back really fast to the commodities and looking at oil prices among other things, because oil prices today are a little bit softer because the Chinese plenum disappointed. I think there are a lot of investors or traders that were hoping that that China would be a little bit more stimulative. China unexpectedly cut rates earlier this week, short-term rates, et cetera. Perhaps the too much leverage in the Chinese system is affecting the economy. What are your thoughts on the Chinese economy and what that means for commodity prices? Because I think the commodity prices are going to have a big impact, not just on inflation and what the Fed does, but it's going to have a big impact on what consumers are thinking and feeling, and even how they might vote. Because to me, that the next few months watching the commodity markets, I think, is the most interesting thing.
yes, Rich, that's another very interesting point. Apparently, the Chinese central bank cutting the interest rate very surprisingly early this week continued to confuse the market, including the Chinese stock market as well. What that really indicated that Chinese central bank or Chinese government are waning the continuously deteriorating of the economics versus simultaneously the capital flow control among just between the China, and also maybe the interest rate difference between the US and China. The interest rate in China now is roughly about 2.2% versus in the US, which is right now still 5.25, so 5%. We see a 3% interest difference here, and now with such a big gap, typically if the capital is allowed to flow freely, we should anticipate that the capital will flow out from China to the US. This is from in a financial theory without some kind of a restriction. Apparently, now to actually prevent that from happening, the Chinese government already imposed many restriction methods trying to actually maintain the stability of the financial system in China, and simultaneously tend not to actually stimulate the economy significantly, given the point that the Federal Reserve hasn't really cut the interest rate. Because whenever if Chinese central bank stimulated earlier by cutting the interest rate too soon or too much, that in addition to stimulate the economy. So we are going to see an opposite effect. We're going to Chinese government might not like to see that the depreciation of the Chinese currency, Chinese yen versus the US dollar. Now, why did they actually do so? In early this week, this is a couple reasons, in my opinion. One thing that the market, U.S. market, pricing the certainty that Federal Reserve is to cut 25 basis point in September. So this actually gives the buffer, very small buffer for Chinese central bank to actually cut the interest rate at this moment to try to level up about the Chinese economy, because last month they just released the PMI data for last month. We continue to see the weakening of the PMI below 50. So the deteriorating of the Chinese manufacturing industry isn't something that's favorable to the overall China's economy. Now, given what that happened, so to actually just continue to or try to achieve the stability of the Chinese economy and simultaneously leveraging up the almost like a certainty of the Federal Reserve cutting interest rate in September, the Chinese central bank decided to take some movement. Actually, they only lowered, I think, the interest rate roughly about 10 basis point. So this actually is not even a quarter point that we anticipate the Federal Reserve is going to cut in September. So I think this is from that point of view, that might actually make sense from the Chinese government. And apparently that's had a huge impact over the energy consumption, because multiple signals have been passed over to the market. One thing apparently will be saying that Chinese economy will might take longer time than market anticipated previously to recover. That Chinese market or China is actually one of the largest manufacturing economies like in the world, which tend to actually becoming imported energy imported country. If that's the case, that we should see the declining of the like the energy price, crude, and consumption. And so that's, I think, some kind of a logics behind that.
Yeah, that's super interesting, and I've put up the charts of oil and then now copper while you were talking, and both, as we can see in both of these commodities, the price has been falling quite a bit in the last couple months, which
Correct.
may benefit somewhat the inflation and the Fed rate cut trade, if you will, but that to me also is indicative that, as you mentioned, of falling demand perhaps in these
Correct.
commodities, and that's not just Chinese demand. There's probably demand in a lot of other places as well, and perhaps even here in the US. And that, but one of the things you mentioned is the interest rate differential, and that's the last thing I wanted to touch on is this US 10-year the 10-year yield. Um, Again, I'm willing to admit when I'm wrong, and Tony, I was wrong. I thought we were going to be closer to 5% by the end of the summer, and here we are closer to 4% by the end of the summer. And so
Yes.
I definitely got this wrong. But to me, we talk about this as another one that I've heard mentioned as part of the Trump trade. But when I look at both administrations, and this is not being political, but I look at both administrations, they both seem to want to spend money. And it just they want to spend money on different things. And I
Certainly.
hear from both sides that they say that inflation isn't a problem as long as wages go higher. Um, and so that to me also sounds inflationary. So I see higher spending, I see discussion about the kind of inflationary policies. Uh, and then the last thing I would say is I saw a stat today in my readings that said that 76% of the federal income tax receipts that the US took in this year went to pay interest on our debt. And that gives you an indication of how much debt the US really has, as we've been issuing $1 trillion every 3 months. And it
Yes.
just blows my mind that we're here we are at 4%. And is it as simple as the fact that US interest rates are just higher than global rates and global investors want to own it? Or is there something else going on in these 10-year bonds?
Well, apparently this is very interesting thing. The 10-year bonds are actually priced mainly by the institutional investors. So what people continue to believe here in this case, even though it actually haven't really gone above like 5%, it continued to uh, come down, like, but still not below like a 3%. Still flowing somewhere around 4.2%. That's just indicated that institutional investors believe that in the long run, the U.S. Will not actually see a recession, and simultaneously will not see a high inflation either. So flowing around like a 4% continue to go down. If actually flowing about 5%, as what you suggest, then they would actually anticipate it. Or at least believing that market might U.S. will continue to suffer with high interest rate. However, this is also very interesting point that you actually brought up about over 60% of that the tax revenue have been utilized to actually to pay for the interest that for the of the U.S. government, and both presidents historically would tend to actually continue to spend, continue to increase the size of fiscal budget to actually power up the economy. Why the U.S. economy and simultaneously actually the U.S. stock market being so resilient and so strong. I mean, one of the biggest driver apparently will be the government taking the leverage, government leverage up instead of the like a citizen leveraging up to actually stimulate the economy. So we regardless like who will come up, either could be President Trump or either could be maybe President Harris. No matter who actually will come in, they will not actually either cut the government spending or fiscal spending. So that's something for sure. And then the question will be where do they actually get the money to spend, right? Where do they where do they get the money to spend? One thing from President Trump's like theory will be we actually cut the corporate corporate tax rate. So the large tax will continue to repatriate the revenue overseas back to the U.S. And simultaneously, the high growth of the U.S. economy will actually generate more of the tax revenue, which actually will be utilized to offset the interest payment due to the high interest rate and simultaneously the higher the U.S. government debt. But over the past now 8 years, we this is apparently not a case. This is not a case at all. Well, this is another bigger question will be: will actually these things will continue to expand like more than 25% actually now, maybe more than 25% of the GDP of the US GDP will be used to pay off the interest rate. That's actually unaffordable for any government. I think that Federal Reserve might actually face a tough decision here. Then they might have to actually cut the interest rate early like next year, because the longer they actually hold the high interest rate, given the softening of the U.S. economy and soft the labor market, the longer they hold it, that actually the more suffering for the U.S. like a budget deficit, government budget deficit here would tend to lead to recession. It's actually very tough decision. So that being said, is regardless whether it's the recession caused the Federal Reserve to cut interest rate, or the Federal Reserve cut the interest rate just simply because they actually preempt us to see the incoming of the recession. Either way, that early next year might be very tough on the market. And so even from now on, we tend to actually maybe recommend the investors to actually follow your advice, like stay vigilant all the time, always now. So I think it will be very tough going forward from this moment. This is just, I don't feel very comfortable about continue to be very risk taking over here, even though market over the short run might still favor the small cap with anticipation the rate cut and President Trump be re-elected, but slightly 1/4 and 2/4 later. Now, what might happen? It's at least not promising.
Yeah, and you're absolutely right, Tony. I mean, I look at this and I think to myself two things. One, I think in the short term, the fact that the Treasury has decided to issue lots of short-dated bills instead of more coupon-paying bonds, that has led to a shortage of supply of bonds, and it leads fixed income investors to have to go and buy treasuries because they have to extend the duration on their portfolio because they're not getting this duration from the government. But that's kind of short-sighted on the Treasury, and that's something where I think that just means that they have to keep coming back to the market in order to issue. And as you mentioned, if we look at the last 8 years, this whole idea that we're going to be able to grow our way out of the deficits that we have just doesn't seem to hold water because the deficits continue to go higher. And as a result, we continue to see longer term rates and move higher as well. Yeah, sure, we got a dip in and around COVID, but we saw the 10-year bond from 2016 to 2019 was rallying from 2% to 3%. We got the
Yeah.
COVID drop, and now it's rallied as high as 5%. Yes, it's pulled back to about 4.25. But I think the market is kind of telling us that if you're going to spend more money, you're going to have to pay a higher interest rate for that.
Correct.
There's
Yes.
some short-term noise in and around there from the issuance, et cetera. But ultimately, we know that the Treasury is going to have to continue to come back to the market to issue because they've been doing everything on a short-term basis and rolling it over, and that is certainly setting us up for a lot of potential problems down the road.
Of
Um,
course. Yes.
and so I'm always one to stay vigilant, and as you said, there's a lot of there's a lot of potential risk in the market, and we're probably not priced for risk. But one of the other risks that we have to appreciate is that people who are managing money for a living don't want the risk of underperforming their benchmark, because that's a surefire way to lose your job.
Yes.
As we
Yes.
talked about, the labor market in financial services isn't the best, and so people will
Correct.
have to be very nimble to try to stay invested when it's important, but kind of get to the sidelines. Any last words here? I know we're kind of up against the hour here. I just wanted to see if you have any last thoughts, and before we head out for the next couple of weeks.
Yes. Here with the, I think the Tesla is going to release the earning very soon, and what we anticipate will be we're going to see maybe the high post earning return volatility starting from now on, not because they don't deliver the strong earning for the Q2, but because of the guidance that might potentially coming up, which could disappointed the investor. So here, trading the post earning announcement, Jeff might need a lot of the like um, care or special attentions, like compared to what we saw over the past 2 quarters. So this is might be all eye vision on the guidance of those kind of Magnificent Seven, which could give us a clue about the future of the market and future of the corporate earning. I think that's very important.
Yeah, and I don't know what Tesla's going to do, but I will tell you my personal opinion is that whenever Tesla came out with the AI story and the AI narrative about 6 weeks ago, and usually they come out with a new narrative just
Yeah,
when they're about to disappoint on earnings in their core business. And so
very likely.
I would have to probably be a little bit cynical and skeptical that their core business is doing very well. Otherwise, they wouldn't have come out with that other narrative. But like you said, it's going to be the guidance going forward.
Yes,
People want to compare this to the internet bubble in the late 90s. But the thing that popped the internet bubble in the late 90s was Cisco missing by a penny and guiding lower, and the stock never looked back, and the market never looked back. And so we have to
correct.
be prepared for that. And it's not going to just be one name. It's going to, if it is one name, it's going to be NVIDIA, but it's going to definitely be these AI related names, and we have to be prepared for that.
Very
But
true.
we will
Very
stay
true.
vigilant, though. So, Tony, thanks for joining me.
Yes.
Look forward to catching up with you another couple weeks. And thanks to everyone who's listening in, whether they're listening on the podcast or they're joining us via YouTube. Please like, share, and subscribe, and leave comments and let us know what you think about what we're talking about. And for now, thanks for joining us on Macro Matters, where we talk about all the macro that matters.
Yeah. Thank you, Rich, and thank you, everyone. And feel free to ask us the questions. We'll see you soon.